Most people think Ethereum is just another cryptocurrency. Something like Bitcoin, but smaller. It's not. And understanding why could genuinely change the way you think about this part of the market. Today I'm going to walk you through the 4 things you need to know about Ethereum. What it actually is, why serious investors are paying attention, and how it might fit into a portfolio. And the 2 main ways to get exposure. And the third section, how it fits in a portfolio, is the one most people skip. And I'd argue it's the most important. Hi, Dan here from 21 Shares. Let's get into it. So what actually is Ethereum? If Bitcoin is digital gold, what's Ethereum? Think of it as a whole new kind of internet. Here's the simplest way I can put it. Bitcoin is digital money. You send it, you store it, you hold it as a long-term investment. It does one thing, and it does one thing very well. But Ethereum is different. Ethereum is a platform. Think of it as a global computer that nobody owns, but anybody can use. Developers can build apps on it, financial tools can run on it, and agreements can execute automatically, all without a company like Google or Amazon or a bank sitting in the middle. That probably sounds a bit abstract, so let me make it a bit more concrete. You know how a vending machine works. You put in your money, the machine checks it's the right amount, and it drops the snack. No shopkeeper needed, no argument about change. The rules are built in, and the machine just follows them. Well, that's how smart contract works on Ethereum. It's a digital agreement that says, if this happens, then do that. Once the conditions are met, it executes automatically. No middleman, no delay, and no room for dispute. Now imagine thousands of those vending machines, all connected, handling everything from instant loans to property transactions to digital marketplaces. That's what's being built on Ethereum right now. People call these decentralized apps, apps that run on the blockchain rather than on a company servers. One thing that trips people up. Ethereum is the name of the whole system, the platform. The actual currency you'd buy or sell is called Ether or ETH. Think of Ethereum as the motorway and Ether or ETH as the fuel that keeps everything moving. When Vitalik Buterin launched Ethereum back in 2015, the idea was to take what Bitcoin had started and push it much further. Not just money you can send without a bank, but an entire infrastructure where value can move, agreements can run, and apps can operate, all without a central authority. And that's exactly what's happened. Today, Ethereum powers the largest ecosystem of financial tools, marketplaces, and digital services in the crypto space. It's the second largest digital asset by total value, and it's the foundation that most of this new financial infrastructure is being built on. So that's what Ethereum is. Not just a coin, a platform, a global computer that nobody owns. But here's the question investors are really asking. Is this infrastructure actually worth investing in? And the answer might surprise you. So why invest in Ethereum? In just the first 3 months of 2026, public companies nearly sextupled their Ethereum holdings. Here's why. Let me start with a number, because it tells the story better than I can. In the first 3 months of 2026, public companies nearly sextupled their Ethereum holdings. That's 6x, to over 4.4 million ETH. That's a treasure chest worth roughly $19 billion. With nearly 10% of all Ethereum in circulation now sitting in corporate treasuries and ETFs, this isn't speculation. This is institutions voting with their balance sheets. So why are they doing it? Well, there's 3 reasons. First, Ethereum has been around long enough to prove itself. It's not an experiment anymore. It's where most of the crypto world's financial tools were actually built. The decentralized lending platforms, the trading systems, and the digital marketplaces. Ethereum is the foundation they chose. And as the second largest digital asset by total value, there's real depth there for large investors to move in and out. Second, the growth opportunity. Think about this. The internet, smartphones, social media, cloud computing, they all started as niche technologies that most professionals dismissed as too early or too risky. Ethereum represents a similar type of emerging infrastructure. It's still early. And historically, the biggest returns in technology come from being early to real infrastructure, not from waiting until everybody else has already arrived. And third, and this is the one that's turning heads, major financial institutions are now building directly on Ethereum. BlackRock, Franklin Templeton, JP Morgan, these aren't crypto startups. These are some of the most conservative financial institutions in the world, and they're choosing Ethereum as their preferred blockchain. That tells you something about where the smart money thinks this is heading. If that reframe just shifted how you think about Ethereum, you're going to want to stick around for the next 2 sections. And if you're finding this useful, subscribing to the channel helps us to make more of these. And we're covering a different asset or topic each episode. So how does Ethereum fit into a portfolio? This is the section most people skip. But if you're someone who already has a portfolio, stocks, bonds, maybe some property, this is actually the part that matters most. Let me start with how professional investors tend to think about Ethereum compared to Bitcoin. Bitcoin is usually positioned as a store of value, like digital gold. Ethereum is more like exposure to digital infrastructure. Think of it as investing in the platform rather than just the currency. Now, 2 things matter here for your portfolio. The first is diversification. Different assets move for different reasons. Stocks respond to earnings, bonds respond to interest rates, and crypto tends to respond to technology adoption and network growth. Because of that, crypto assets have historically shown relatively lower correlation with traditional investments. Adding a small allocation, no more than 5%, has, in some periods, improved overall portfolio performance. Though, of course, past performance doesn't guarantee future returns. The second is something investors call asymmetry, and this is worth understanding. New technologies often start small, but if they succeed, the upside can be significant. You don't need a huge position to benefit. A modest allocation gives you exposure to that potential upside while keeping the downside risk proportionate to what you can afford. So how much is right? Well, that depends on you, your risk tolerance, your time horizon, and honestly, your comfort level. A good rule of thumb is this: size it so you can sleep comfortably at night. If you're checking the price at 3 a.m., you probably own too much. So how can I invest in Ethereum? Should you buy Ethereum directly or invest through your existing broker? There's no wrong answer, but there is a right answer for you. There are 2 main paths, and the right one depends on how hands-on you want to be. Path 1 is direct ownership. In the industry, this is called self-custody. You buy the Ethereum yourself, you hold it in your own digital wallet, and you have complete control. It's the purest form of ownership. But there's a trade-off. Complete control means complete responsibility. You're the security guard, the IT department, and the backup system. And there's no forgot password button. If you lose access, there's nobody to call. This path suits people who are comfortable with technology and genuinely want full control over their assets. Path 2 is exchange traded products, ETFs or ETPs, depending on where you live. These were designed to bridge the gap. The actual Ethereum is bought and stored for you by an institutional grade custodian. Your investment tracks the price, but you don't have to manage a digital wallet or worry about losing your keys. There are some real advantages here. Because these products trade on major exchanges like the Nasdaq or the London Stock Exchange, you can buy them through your existing brokerage account. And, depending on your region, you can often hold them in tax-efficient retirement or savings accounts. The way I think about it is this: direct ownership is for those who want to drive the car themselves. ETFs and ETPs are for those who want to get to the same destination but prefer to use cruise control. One thing to look for if you take the ETP or ETF route: make sure the product is physically backed. That means the provider actually holds real Ethereum on your behalf, not a derivative or a promise. It's worth checking who the custodian is and how transparent they are about where the assets are stored. Now, whichever path you choose, there are some risks worth knowing. Ethereum, like all crypto, can be more volatile than equities or bonds. Regulations can change, and custody choices matter. Do your own research, read the documents, and understand what you're buying before you buy it. So in summary, let's bring this back to where we started. Most people think Ethereum is just another cryptocurrency. Now you know it's much more than that. It's a programmable platform that's attracting billions in institutional capital. It could play a role as a diversifying, growth-oriented piece of a portfolio, and you can access it either directly or through regulated products you can buy through your existing broker. The question isn't whether this technology matters. The institutions have already answered that. The question is whether it deserves a place in your portfolio, and at what size. And only you can answer that. We're building a series that takes you through each major crypto asset one by one in plain English. If this was useful, subscribe so you don't miss the next one. And head to the 21 Shares website for more detail. The link's on screen now. See you next time.